Should you be using more than one financial advisor? I'm Marc from Winnipeg Financial Planning. Let's dig into it. Instances of clients using multiple advisors rose after Bernie Madoff's Ponzi scheme was revealed during the 2008 financial crisis. However, in good or bad times, using multiple advisors can lead to higher fees and lost efficiencies. Nobody wants to be the victim of a Ponzi scheme, so using multiple advisors sounds appealing because you're diversifying your assets across multiple advisors. The big issue for investors in Bernie Madoff's Ponzi scheme was that Bernie's firm was the one holding the investments as well as issuing the statements. There wasn't a third party involved to make sure that the available funds matched the client statements. This can be avoided by using an advisor that uses a third party custodian to hold investments in clients' names as well as issue account statements. For example, John Smith is a financial advisor with XYZ Wealth Management. XYZ Wealth Management employs a large Canadian bank to hold client assets and issue statements. So in this scenario, John Smith doesn't have direct access to his clients' accounts, and if XYZ Wealth Management were to go out of business, client accounts wouldn't be affected because their money is held at a large Canadian bank. Another reason to use multiple advisors is to diversify your investment holdings. So if you have one advisor that specializes in Canadian stocks and you have another advisor that specializes in, let's say, European stocks, you're getting the benefits of diversification. However, this is generally not the case. What we often see is that both advisors are buying similar investments. For example, Jane works with two advisors. Advisor A bought her the BMO TSX Canadian ETF, and Advisor B bought her the iShares TSX Canadian ETF. If we look at the top 10 holdings of both of these investments, the holdings are essentially the same, so there are no diversification benefits to using multiple advisors in this scenario. If you were buying groceries, would you rather have 7-Eleven or Superstore prices? Most financial advisors are compensated by the amount that you invest with them. So generally speaking, the more that you invest with one advisor, the lower that their management fee is going to be. So rather than investing with multiple advisors and paying higher fees, you'll likely pay less by investing with one advisor. A crucial part of tax planning is being extremely precise. Using multiple advisors makes you risk missing out on efficiencies because the left hand isn't talking to the right hand. It can be challenging for multiple advisors to coordinate and agree on the best strategies. For example, Rick is 66 and working with two advisors. Advisor A put a plan together to cap Rick's income at $80,000 for the year so that he is not affected by old age security clawback. Unknowingly, Advisor B withdrew funds from Rick's RIF and triggered some gains in his non-registered account. This increased Rick's income to $110,000 for the year, and he was now losing out on some of his old age security benefit. When using multiple advisors, the client is the one left in the middle to coordinate strategies. This can often lead to more work and more stress, which is the opposite of what most people are looking for when hiring a financial advisor. If you enjoyed the video, hit the subscribe button. It helps us out tremendously.